Ian, welcome to the podcast.
Thanks, Rob. Glad to be here.
Well, I'm so glad to have you, another first-time guest on The Art of Boring. And so I wonder, can you give us a little bit on your background and how you got to Mawer?
Yeah, sure. So I've been at Mawer just over 4 years now. I joined in November 2020, which was a fun time. Started out, I was went to Laurier, studied finance, was in Toronto working for another firm there, doing healthcare and a bit of consumer as a specialist. So it was a little bit different as a kind of sector specialist type role, doing mostly global healthcare. And what attracted me more was just the, I guess, investment success they'd had, a lot of really good investors here to learn from, and the opportunity to be a generalist, take my learnings in a couple sectors and try to apply them around the world across all sectors. So it's been a fun transition. Moving to Calgary as well has been awesome. And yeah, I've really enjoyed it.
Fantastic. Well, you joined our EAFE Large Cap team, and we're here to talk about that portfolio. I asked this half facetiously, but also half seriously. U.S. equities have just trounced other regions in the world over the last 10, 15, 20 years. We're talking substantial outperformance. So, genuine question, why even have an EAFE portfolio in your asset mix? Why not all U.S. stocks?
It's a good question because doing that historically would have worked pretty well. I think starting point is kind of more bottom up. We are finding great companies that fit our investment philosophy really well in EAFE today. I think the portfolio, we have a lot of those in the portfolio, and we got a really deep inventory list of stuff, dream list, things we would love to own at some point. So it's kind of how I answer a lot of questions of maybe why do you have more exposure here or there? It's often comes up to the bottoms up what we're seeing on the ground, kind of company by company. I would say there can be lower quality areas in our universe. And so I think our kind of win by not losing strategy can work well. We're agnostic to the benchmark. There are areas that we won't own much of and areas that we'll own a lot of. I think too, the US, if you think of a 100% US portfolio, two big risks there. One would be just concentration risk. The US is one country. It's very diverse, but it is one country. It's had its historical volatilities and fragilities. And even with geopolitics, it can be kind of unique to it. And the other one would be valuation risk. Right now, the S&P 500 is about, the forward price earnings ratio is about 65% above the equivalent in Europe. And historically, that's been, the last 20 years has been about 10 or 20% premium. So quite possibly deserves a premium. But the last, especially 5 years, we've seen that premium blow out substantially. I think the difference the outperformance has been more than half the last 10 years has come from multiple expansion. So yeah, the US has done really well with great companies, but there is a valuation, maybe fragility there as well. And I guess one thing too is when you think of the EAFE universe, there's 21 countries, and there are some really good ones here. There's some issues that grab the headlines, but I think especially on the smaller country side, a lot of really attractive situations. You think of the Nordics, there's 5 countries there that are all generally doing really well. Also in Europe, you'd have Switzerland is doing really well. Ireland has emerged as a really bit of a powerhouse. Holland, particularly the ASML, has done great. And then if looking over in Asia, Singapore looks extremely attractive. Australia, some characteristics like Canada, but some really great countries there as well. So when you look at some of the smaller countries, there are really attractive opportunities.
And when you say attractive opportunities in these countries, I think I know the answer, but you're not saying that somehow these are economic powerhouses that are domestic plays. You're suggesting that for whatever reason, cultural, happenstance, density, whatever, these smaller countries tend to punch above their weight in terms of producing global leaders that compete against the very best US companies too.
Yeah, we see a lot of that. So I think one kind of deductive reason could be small home markets. So they got to look abroad to export. That's often people point to Sweden, Denmark, the Nordics, Switzerland for that reason. They couldn't just stay within their own borders like a lot of US companies do, and for good reasons. They got to look abroad. So if we think of Denmark with our Novo Nordisk, with GLP-1 and insulin, they've always been an exporter of that, always focused abroad internationally. If you think of Sweden, a lot of really strong industrial businesses have been around for a long period of time where, the home market is 1 or 2% of their of their revenue, and they're extremely international, very good at localizing things and being a world leader. Switzerland as well, great pharmaceuticals, medical devices, leadership, various industrial niches and consumer brands, got from chocolate to luxury. And even Japan, which maybe has some of its problems, but really good exporting companies, often with almost 100% market share and very little niches that they've iterated on for generations, and the employees don't leave. So you get them throughout their life, and there's a lot of learning that is very unique versus the US. And I guess one part I'd touch on too is just Mawer's kind of abilities internationally. We're kind of an offshoot of our international team, which has a really long track record of success and process for investing internationally. And within EAFE Large Cap, we fully overlap with international and global. So there's a lot of eyes looking at these companies. From the analyst perspective, it's great because I get a lot of potential owners of ideas and perspectives and debates. We have a lot of people traveling through these countries frequently, a lot of languages that we speak within the team. Our Singapore office is awesome for getting local insights there and working on that time zone. So I think the team and the process is really set up well to be successful in these geographies too.
You mentioned it, but one of the aspects of this portfolio compared to perhaps other international portfolios or global portfolios that we manage is the distinct focus on developed markets and the distinct focus on larger cap. How are you defining larger cap, and why? Why is that? Why does that make for a good universe?
Yeah, so for us, large cap, it's the top 2/3 of the MSCI EAFE index. So the index is about 800 companies. We're about 550 are within our index.
And just market cap wise, like what would be the bottom end of your range?
It's about 11 billion USD right now. So that's kind of where we cut off the bottom. I think within this, there's always gonna be pros and cons, but you have a lot of historical resiliency. He's been around for a while, been through cycles, been through wars. They have to have proven moats because of this. It's one risk with some newer industries and companies, but I think the US is just high growth, but maybe no moat. It hasn't been proven yet. You haven't tested it. You haven't had new entrants in periods of weak demand to kind of test that out. These companies some have been around for over 100 years, tons of cycles. There is more kind of proof of that moat and the ability to create value. And I guess too, it's large cap. You have more economies of scale, more resiliency often with these businesses, the ability to be world leaders in what they do. And companies and countries kind of graduate into it. Once a country is doing well, MSCI will put them into the developed market category. If a company is doing well, they grow into our size range. So there could be positive selection bias, would be one way I think about that too.
Well, I'd love to hear a little bit more flavor on the portfolio. And I thought the way that we do this is just, go through some of the more significant holdings, get a sense for what these companies are, what they do, how we came across them, why they deserve a place in our portfolio. And through that, just get a sense for the general flavor of the portfolio too. Can we start with what I believe is the number one holding, Wolters Kluwer? Hopefully I'm saying that right. Who are they?
Sure. So it's kind of grown into our top holding, good performance, and it's been a very long-term one as well for us. They provide workflow solutions for professionals. So lawyers, accountants, tax professionals, healthcare professionals, doctors, nurses, all use their information solutions, which are kind of like software tools, to make decisions, to reference case law, tax laws, best practices in healthcare. They provide these solutions to customers. When our international team invested a long time ago, this was kind of going through a print to digital conversion. And we kind of had a long-term perspective. We thought the management team were excellent and capable of executing this. And the risk was it went the way of the yellow pages, which we know how that can end up. But the benefit here was it really successful, turned into a higher margin, more recurring business. And it's really able to drive a lot of value for customers, automating things, making the professionals faster what they do, more accurate. The Spanish hospital system uses their UpToDate healthcare tool for all of their hospitals around the country. I've been doing that for over a decade. And it's also a bit of a play on AI as well. Just they have the data of customers. They have really deep relationships with these customers. So they can take the AI tools, sell them into the customer base. And it's for another way they just create value, share with customers, keep some for themselves. And this is just a very steady, reasonable grower with good margin expansion. It's been a good story for us.
I was going to say, sounds like pretty sticky customers, pretty highly recurring revenue.
Definitely really high recurring revenue. But even with, especially the transition to software, we've seen that recurring piece grow more, the stickiness get tighter, and it's very flat market shares. It's the kind of thing when you're trained on something, a software tool, a lot of your employees, you don't really want to switch off. There's not much of an impetus to. They've done a good job of just maintaining that customer relationship and making sure both sides you're creating value for the customer as you're developing new tools and charging a bit more for it as well.
Reference information for lawyers. It sounds like a beautifully boring business. Can we move to one that might be perhaps a little more exciting? Another company in our top 5 is BAE.
Sure. So this was an investment we made in EAFE just before the Ukraine war. And that wasn't our base case. What we liked here was, one, it is a wealth creating company. It's quite asset light. The government's often funding your CapEx and often your R&D. So even if you have a relatively low margin, you have a really high return on capital. It had its struggles historically, but new management team was really focused on improving profitability and risk mitigation and kind of the contracts they're willing to sign and avoiding a lot of fixed price that had been an issue historically.
For clarity, this is a defense contractor.
It's a defense contractor. So they make, defense products, very, very broad. It's UK based, but they have a very large US and European business as well. And I think one thing we really liked about it was the portfolio considerations. Its growth is very idiosyncratic to the rest of the economy. Defense spending is pretty stable. It's on a different cycle in the economy. They had a bit of a pension liability, and we saw rates were going up at the time, so that was actually going to benefit the pension as well. And it's often obviously a pretty good hedge on conflicts. So it's been a good one, and we see now with the impetus to spend more on defense, Trump pushing NATO countries to meet their targets. There's a lot of momentum behind defense spending, and this is one industry that Europe is probably going to be much higher growth than the US. So it's one we've added other defense companies as well since, and it's been, it's still very reasonably priced for the kind of quality we see.
With a Trump presidency, what does that mean, if anything at all, with respect to those US government revenues that BAE has? Is there a risk to them, or is it a pretty strong relationship?
Yeah, we'll see what they do with spending, what areas they look to cut. There's very high barriers to entry for these programs. BAE will often work with a prime, larger customer in the US to develop programs. And jets can take over 10 years to develop, very high barriers to entry. We definitely are seeing more new entrants that have different business models, might be a little bit faster, starting to win some business, but it is high barriers to entry. Defense spending is a big priority. It's bipartisan in most places and in the US today. So I think they'll be selective with what they look to reduce. And definitely, US may spend less internationally. They may not be willing to kind of fund a lot of Europe's defense, and that's an opportunity for BAE for these countries to spend more themselves.
Can we shift from Europe to Japan? I'd love to hear more about Chugai, and perhaps this goes to your roots before Mawer as a healthcare analyst.
Yeah, Chugai's a fun one. So this is, for background, Roche bought a controlling stake in Chugai back in 2002, and Chugai has acted as Roche's Japan subsidiary since. So they distribute all products for Roche in Japan. It's a very efficient commercial structure, and Roche commercializes and develops stuff for Chugai outside of Japan. Historically, that's what Chugai was. They're a very good distributor, not much innovation. But really over the last 10, 15 years, they've become Roche's kind of R&D engine in a lot of ways. I noticed a lot of the high quality products of Roche coming from Chugai. So about 2 years ago, went there, met with the whole management team, was impressed with how they thought about the relationship, the scale benefits they get, the R&D and innovation that they've been able to develop has been really awesome. And you often see Japanese companies, they're good at R&D, bad at commercial, and even worse internationally. So this allows Chugai to focus on what they're great at, developing things, commercializing in Japan, and letting Roche do it outside. Then we've seen great results. Hemlibra is one product which they've developed. It's almost going to have half the hemophilia market now. It's a very complex molecule at the time. And the one we're excited about for kind of early next year is their GLP-1. This was actually partnered with Eli Lilly because Roche chose to pass on it back in 2018. But it's an oral GLP-1, so it's different from the injectables that are currently on the market. It's going to be highly competitive. We think it might open up a new market segment that doesn't want to have the injection. And they have a great commercial partner with Lilly, and Chugai gets a nice royalty. So it's actually a pretty good upside opportunity on that.
So this positions them as a rival in some ways to Novo Nordisk, another portfolio holding.
It does. And Novo's done a great job with GLP-1, with innovation over the really long term. I think one concern is just the level of competition kind of entering. there. So as you kind of pared back Novo, I think Chugai has been a nice portfolio offset as one of the new entrants that might disrupt or change the market dynamics a little bit. But Novo's been a great company, very well run, and really spearheaded the GLP-1 kind of revolution and believed in the obesity opportunity 5, 7, 8 years ago when no one else did.
Can we stick with Chugai? And a couple following questions that are either specific to Chugai or just healthcare more broadly. AI and pharma or R&D, what are those? How should we think about that going forward? On the one hand, I would imagine that so much more might be possible. On the other, I would imagine that it reduces the barriers to entry, makes it easier for subscale competitors to do more. Am I right in thinking of those two things, or how would you think about the impact of AI in the healthcare space?
Yeah, I think within healthcare, if we focus on R&D, because it has broad implications, of course, like any industry. We often think of R&D, it's really hard to define who's the best at R&D and why, but there's something special in the culture that's how they do things. And so I think the best R&D cultures will integrate AI well. We're seeing that with our companies. We're talking to them frequently. It's a great tool for the discovery process. Often involves looking at thousands of different molecules to see what might fit the best kind of at the preclinical stage. And a lot of stuff fails. Only about 10% of stuff you bring into phase 1 gets through phase 3. The cost of developed drugs is continually going up. It's well above $1 billion at this point. So the promise of AI is you get faster, you get to look at more drugs, find a more optimal one early on, possibly do more optimizations before going in the clinic. So you end up with hopefully something better, going faster at that stage, but there will still be the clinical stages. It's very regulated, so there's kind of limits with how fast technology can penetrate healthcare. I think a lot of people are disappointed. But I think there's a good opportunity for the best at R&D to kind of get better, to lower the cost curve, maybe get higher return on their investment. So it's an exciting time for pharma, and I think we'll see a lot more innovation with that.
Connected to exciting times, I want to ask you about valuation on, whether it's Chugai, Novo Nordisk, maybe even outside of your area, and Eli Lilly. With, like you said, potentially more competition, obviously GLP-1s being such a huge success, presumably everyone's trying to catch up or do something in that regard. How do you think about valuation in this space, and maybe Chugai specifically?
Yeah, I kind of think of ranges here because it's a different way of approaching it. Historically, these markets were kind of, for pharma, we kind of define cancer. You know how many cancer patients this are. You can do a model that's pretty tight. Here with obesity, it's very broad. We kind of ran like market models for it, thinking of how penetrated it could be, what the price point might be, assuming that comes down with more competition than the market share for your product. But always putting a really wide range of the assumptions there, kind of with our Monte Carlo. It's difficult. You're always looking out for a pharma company. It's, in 15 years, most products will be off patent. So you're modeling something out that you don't know what's going to be there then. Assuming a return on their R&D is something I'll often do in my model. They're kind of bespoke for each company. But when you look at it, at Chugai that's generated very high returns on R&D, I can assume that comes down quite a bit and still get to pretty reasonable valuation today. But I would say with the GLP-1s, people have got excited. It's no longer an easy free call option like it was once for Novo. And you got to think of the competition side too, but it's definitely an attractive market, and there can be a lot of value creation for the company and for society, I think, with it.
Another company I wanted to ask you about was Haleon. I imagine the ranges in the DCF are a bit narrower for this one, but correct me if I'm wrong.
Much narrower. Yeah, Haleon's a consumer healthcare company. So they are brands you might know in pharmacies such as Advil for pain, Centrum for vitamins, Sensodyne for toothpaste, sensitive teeth. And
okay, we're back to very boring.
We're back to very boring. Yeah, the range is much tighter. You think of the fair value and the assumptions, you can get much more confident in. These brands have been around for a long period of time, and they grow within a pretty narrow range. But it definitely serves its role in the portfolio well. It was spun off from GSK and Pfizer about 2 years ago. I followed it for over 10 years, kind of on the healthcare side. It was always the best part of GSK, but not perfectly run. Often the pharma side had some dyssynergies with it. So with the spin-off, I think initially the excitement is cost cutting. They can reduce some of the the pharma excessive overheads and whatnot. But I think longer term, the opportunity to improve the speed and the culture is exciting. I talked to a lot of former employees before we made the investment, and the consensus was great company, great brands, but just a little bit slow. And one example was the compliance required to talk to a dental hygienist about toothpaste was the same to talk to an oncologist about chemotherapy. So that's going to change. They have CEO here is from P&G. He's brought a lot of P&G people over. They have the chief marketing officer from L'Oreal on the board. So trying to get faster for what's a very good underlying business. And but yeah, tighter ranges than a Chugai here.
And the last one I wanted to ask you about more, because I think you just visited with them, is Lonza in Switzerland.
Yeah, Lonza's our contract manufacturer of biologic, and think of it as complex pharmaceuticals. So they do this for pharma companies on an outsourced basis. Their end markets have really nice growth, biologics themselves, and then you tack on the outsourcing trend that's happening in the industry. And Lonza's done a really good job of capitalizing on this.
What's driving that trend? Is it just, like you said earlier, it's just costs that much more to develop a drug? It's that much more complex such that the economics are better to outsource versus developing that expertise internally?
It would depend on the area. There are some where it's so complex to manufacture, Lonza is the best at it. Antibody drug conjugates are like 3 different molecules pieced into one, and Lonza is the best at in the world. They have well over half this market. That's the complexity side. I think on the other piece is just financially, it can be more attractive for customers to outsource. Lonza they have about 3 times the scale of any pharma company for manufacturing, and they can spread the cost over more customers. If they can have capacity ready for customers that have a launch, maybe uncertain on the demand. So if a customer builds a lot of capacity, demand isn't there, that's a big risk for the customer. And there's a trend of biotechs are about half Lonza's business, and they often don't have the physical infrastructure. Raising capital will be more difficult. So you're turning a CapEx into an OpEx with a really trusted partner. And yeah, Lonza serves customers very well. Great on the being forefront of innovation where customers need to be. I visited them in Switzerland a few months ago. Was really impressed with what they're doing. There's a small town in Switzerland called Visp where they have basically half the workforce is for Lonza, and just learnings iterated over decades they managed to do.
You mentioned it a bit with BAE, but just thinking through the names that we've talked about in the portfolio, the companies and what they do, just any material portfolio considerations as you guys as an EAFE Large Cap team get together and obviously talk about individual companies, clearly a bottom-up process, but how they stitch together. What are you discussing or debating most with respect to that composition today?
Yeah, I think we want to make sure the portfolio is resilient. So we think about risks, and there's hundreds, thousands to debate, discuss that we're aware of. Not trying to put a probability necessarily on them, but just being awareness of them. If this happened, what would the portfolio look like? What would the impact be? Ideally, we have contradictions. So if this unknowable future event unfolds, these companies might do well, these companies might suffer. So some nice offsets there. And we think about themes that are happening in the world today. We think of pharma innovation, which we talked about, the GLP-1s, AI, electrification, defense as being a big theme now as well. Is like, do we have the right exposures to those themes to make sure that we have some nice tailwinds from that? But ideally, finding contradictions in the portfolio. BAE is a nice example where it's, a very different cycle than the rest of things. Haleon's one where it's just very stable. But then having some more upside opportunities too, with maybe a Chugai that you could see as having more upside, and thinking with our valuation approach and process, I think is pretty good, kind of stretching out what could be that those upside cases, as well as the downside. So it's, kind of blending all that.
Are there any themes you're talking about that you feel are sort of under the radar? We hear a lot about GLP-1s and obesity, but are there others, kind of going back to the beginning of the conversation on, this U.S. equities, and we've just had an election, this being an EAFE portfolio, where are the sharper exposures with respect to geopolitics or tariffs? We spoke about BAE, but are there other angles in the portfolio that you're mindful of today, either from a winning perspective or where there might be more risk?
Yeah, definitely something I talk about a lot. I think it's kind of like when we had higher inflation. We think about the business model quality. If a tariff comes into place, can the business do they have pricing power? Can they pass that on to customers over a period of time? Often, if they're differentiated products, pretty captive customers, they're able to. I guess also, are they on an equal playing field with competitors that also phasing this? So that can often work out quite well. We do have a lot of companies that have very local U.S. operations that might benefit from more localization in the U.S., more construction spending there. And I think too, with the geopolitics, which is very unpredictable, some nice hedges there on the defense side. But that's definitely an area that getting more and more attention. And we think about a lot.
Okay. Well, Ian, appreciate the tour. Appreciate the deep dive on a few of the top holdings. And again, thanks for coming on the pod.
Thanks, Rob. Yeah, enjoyed it.